Welcome to October edition of our market commentary, where we unpack the economic and market forces shaping investor sentiment globally and in India. After a volatile September, October brought a noticeable shift in mood. Markets across the globe, including India, turned upbeat. Two major tailwinds, a tariff truce between US and China, and the US Federal Reserve's rate easing cycle have helped lift the globe. In this month outlook, we will explore these developments and more, so let's quickly dive in. In its October meeting, the US Fed cut the key repo rate by 25 basis points, citing rising downside risks to the job market. What stood out this time was the Fed's acknowledgement that its decision was based on limited data. Note here that due to the ongoing US government shutdown, several key releases across labor, inflation, spending, and housing have been delayed indefinitely. More importantly, the Fed made it very clear that a December rate cut isn't a given. That's a departure from its usual signaling and suggests growing tension among policymakers over how to balance the inflation outlook with emerging risks in the labor market. The US Fed reiterated that it was concerned about a slowdown in hiring. This comes against the backdrop of layoffs at large US companies, including Amazon and General Motors. However, the Fed didn't signal that inflation concerns are behind us. The US Fed highlighted that inflation has moved up earlier in the year and remained somewhat elevated. The US inflation data, which has delayed due to the US government shutdown, revealed that the prices were up 3% in September. This suggests that the impact of Trump's tariffs is steadily filtering through the consumer prices. This puts the Fed in a tough spot. On one hand, it's facing pressure from a weakening labor market. On the other hand, inflation is still very sticky. That tension is likely to deepen the divide between the Fed and the government in the months ahead. October was a strong month for global equities. Markets were clearly in a buoyant mood as tariff negotiations were underway and interest rate cuts have come through. In the US, the markets rose, hitting a fresh all-time high. A lot of that momentum is still coming from the AI wave. Besides this, the US Fed rate cuts also gave a boost to sentiment. Asian markets also had some standout performances. Japan rallied, largely on expectations that the new government will step in with a fiscal injection. South Korea also made solid gains as investors responded to corporate governance reforms, booming exports, and AI wave. Meanwhile, China continued on its upward march. Overall, it was a month where optimism returned as investors leaned into growth narrative across regions. Indian markets made solid gains in October 2025, in line with global trend. The indices rose, getting closer to record levels. Rate-sensitive sectors and telecom led the broad-based rally. Banks were one of the top performers, propelling the markets higher. From low bad loans to a clean balance sheet and robust credit growth to valuation comfort, multiple factors are driving banking stocks. Beyond banks, in October 2025, telecom and real estate sector also made robust gains. We are seeing a clear shift in market sentiment, from cautious to cautiously optimistic. A confluence of factors is driving this change. Strong festive season, demand pickup, signs of a revival in corporate earnings, benign inflation, and the growing possibility of a trade deal between India and the US. Together, these are giving investors reasons to turn bullish. What especially noteworthy is the return of foreign investors. After 3 months of net selling, large overseas funds are once again buying into Indian equities. That steady comeback signals renewed confidence in India's macro and market fundamentals. Meanwhile, domestic institutional investors also continued to support the markets. So far, Q2 earnings from domestic focused companies have exceeded expectations. Pre-festive demand and the infrastructure momentum have supported strong volume growth in sectors like cement and steel. What's encouraging is the large industrial groups have announced fresh capex plans, especially in cement and oil and gas, which signals growing confidence in the investment cycle. Large banks' corporate loan books continue to outperform, backed by stable asset quality. Meanwhile, large private sector banks reported a fall in profitability and lower PAT growth, primarily due to recent rate cuts. But the good news is that profitability appears to have bottomed out and should improve in the second half of FY26 and FY27. On the consumption side, trends are mixed. Discretionary categories like auto and quick commerce are holding up well, while staples and food delivery are seeing some softness, likely due to GST related adjustments and shifting consumer preferences. Hotels and large real estate players have reported better than expected results despite the seasonal weakness. IT services growth was muted but slightly ahead of expectations with cautious commentary from Tier 1 players. In summary, resilience in domestic demand-driven sectors and financial stability are emerging as key anchors as we head into H2. Meanwhile, global uncertainties continue to weigh on export-oriented businesses. We have maintained throughout the year that gold prices are likely to stay elevated amid rising global uncertainty. Even the recent correction, gold has delivered solid returns in 2025. While progress in the US-China trade talks has weighed on prices, central bank buying remains a key support factor and could continue to lend strength. Silver prices have also been under pressure as the historic market squeeze eased. To sum up, the overall trend for precious metals remain volatile, and that's likely to persist as global uncertainties continue to play out. Oil continues to trade below the $70 per barrel, and sentiment in the market remains largely bearish. Even with fresh US sanctions targeting Russia's biggest oil producers, prices have remained range-bound, mainly because OPEC countries have kept increasing supply, which is putting downward pressure. That said, the Russia situation remains a key monitorable and could shift dynamics quickly. Softer oil prices help improve India's current account balance and keep check of inflation. In the current global environment, we favor domestic-oriented companies over export-oriented ones. Private banks and select PSU banks. Select large private banks continue to trade below long-term average valuations despite stable asset quality and earnings growth. And in the case of PSU banks, the asset quality, growth and ROE profile are holding up very well. Capital markets and exchanges. Benefiting from the strong structural tailwinds of financialization of savings, GDP growth and increased equity participation and potential market cap growth are clearly visible for this sector. Defense, infrastructure, manufacturing. The Make in India push and PLI schemes are empowering domestic capital goods firms to compete globally. Favorable conditions like clean balance sheet of banks, stable government policies, and low interest rate environment are beneficial for companies from infra and manufacturing segments. Cement. Industry consolidation is driving a balance between volume growth and profitability. Automobiles. Positive on two-wheelers and select passenger vehicle OEMs, supported by rural demand and easing input costs. Auto ancillaries offer resilience across cycles, being less affected by shifts in brand preferences. Healthcare, especially hospitals, with just 1.4 beds per 1,000 people, far below the WHO benchmark. India's healthcare infrastructure offers long-term growth potential. Private players are scaling rapidly, gaining traction over the past decade. Also note that these sectors, especially financial services, automobile, and auto components, cement, and healthcare, are expected to be major direct and indirect beneficiaries of recent GST reforms. At ASK, our house view remains firmly tilted towards large caps, as that pocket looks reasonably attractive from a medium-term perspective when we compare with other market cap segments. We see stronger earnings durability, macro resilience, and valuation comfort here, especially as India's valuation premium faces scrutiny. Historically, during periods of uncertainty, large caps have outperformed small and mid-cap segments by a significant margin. Stronger balance sheet, deeper institutional ownership means that large caps are better equipped to handle volatility than small and mid caps. With global policy uncertainty, tariff risks, and uneven earnings still weighing on sentiment, these defensive attributes matter most today. Moreover, we are seeing FIS coming back to Indian markets, and this could be a good time for the large cap segment to do well. Thank you for your time. We will connect with you again next month.